The Reserve Bank is being urged to raise rates slowly by the CBA. Let's have a look. Hello everyone, Florian Heise here, and welcome to another episode of HeiseSays. Grab your stein of coffee, if you can, or sadly like me, your 7-Eleven hashtag not sponsored $1 coffee because you discover the morning you're going to record that you're out of instant coffee in the house, so you have to drive up the road, but still, going off topic, like always. Now, I want to have a look at this article from the Australian Financial Review because, well, I think it's quite interesting. We have the CBA, one of the biggest banks in Australia, urging the Reserve Bank of Australia to raise rates slowly. Now, when I saw this article, the first takeaway I had was that we're not at all in a free and open market. I think we've all come to realize that now. You've got all these people that are predicting a dire housing market here in Australia, and we had our first recession in 28 years. And in all fairness, the government intervention into the economy to lock everything down should have really pushed some people who were right at the edge, tipped them over. It's not fair, it's not nice, but this is what has to happen in a free market. People who, well, take risks, people who leverage too much, people have to learn lessons. Businesses that aren't profitable, they need to be cleared away, like a forest, so that there can be young growth coming up, reaching for the sunlight. But it doesn't feel like that happens too often in this situation, in the economy that we have here. And we all know there's definitely votes for the government in intervening. We saw, mortgage keeper. It's not a real thing, but it'll materialize. 2% home loan guarantees, 5% home loan guarantees. Not one bank foreclosing on anyone over the last few years. You've had mortgage holidays. Remember all the articles we were reading from the ABC about professionals, a dual income professional couple thankful for mortgage holidays as the only way they could keep in their house. Let's jump over here before we go through this article. I asked you on a poll, do you own CBA shares? Please let us know your opinion about CBA urging the RBA to raise rates slowly in the comments. Now, only 16% of you own CBA shares, 84% don't. I have CBA shares. Now, I'm happy with their fat profits because, well, I'm a shareholder in CBA. I know some people are worried about bank bail-ins and all of these things, but we've seen now that our government is more than willing to intervene in the economy to prop up different sectors. Housing is, well, their favourite. I talk to tradies every other day at the moment, particularly now when I'm building my house, and I'm going, who would have thought it'd be this busy, this insane after our first recession? So let's look at what CBA are calling for the Reserve Bank. Aren't the Reserve Bank meant to be completely independent? Commonwealth Bank CEO Matt Comyn has said the Australian economy's strong post-COVID-19 momentum will continue until at least the end of 2023, triggering multiple cash rate increases starting in August, as he announced a strong rise in the bank's half-year profits. He urged the Reserve Bank to take a gradual and modest approach to raising rates, recognizing the sensitivity of the housing market to higher mortgage costs and lower expected inflation in Australia compared with other big economies. Now, just for memory, guys, I'm going to bring up, or just pretty much for fun, I'll bring up this little chart here, which is showing you the current cash rate. I haven't updated it for several months because the cash rate is sitting at 0.1%. Now, in the past, we'd gone through articles about housing and the Reserve Bank where 3% was considered an emergency rate. 3%. Wow. And that's from the Reserve Bank. And we'll look at another video today where the banks have started raising rates already individually. Commonwealth Bank has emerged from the pandemic in robust shape, reporting a 23% jump in interim cash profits to $4.7 billion, following record aggregate growth in home loans, business loans, and deposits. Okay, home loans propped up by government intervention. Business loans propped up by RBA intervention. deposits, all of us frantically saving, either through receiving additional money from government intervention, or we're just worried. The growth allowed CBA to splash $5 billion of cash on shareholders via a $3 billion interim dividend and an additional $2 billion share buyback. The stock closed up 5.58% at $99.56. CBA forecasts underlying inflation to average between 3% and 3.5% in 2022, above the Reserve Bank's target range. Mr. Cormann expects the cash rate target to rise from its historic low of 10 basis points to 75 basis points. This pace of increased rates could be absorbed by borrowers and would lead to only modest falls in house prices in 2023, Cormann said, but more aggressive central bank action would intensify the risk that its cash rate normalization would damage the economy. Well, we've seen this in the US. We'll have to keep an eye on how they go with their rates. We think rates will go up quite slowly, he said. We expect the strong economic momentum to carry through to at least the end of 2023 and feel very optimistic about the outlook for the Australian economy over this period. The impact of the Omicron outbreak had been more modest than expected, and spending slowed only marginally, he declared. But rising interest rates are now the core focus for bank analysts and investors that are diverging views on the impact the looming tightening cycle will have. CBA emphasized that higher rates would create tailwinds for its net interest margin, which will be supported by fewer customers taking out lower margin fixed-rate home loans, and its banks earn higher interest on the capital. But investors are fretting about higher rates pushing up bad debts, which would directly hit bank profits and put pressure on the housing market. You have strong house prices, low unemployment, low bad debts given government support, and interest rates being so low. But the flip side is, how much better can it get? Said Hugh Giddy, Senior Portfolio Manager at Investors Mutual. Mortgage stress. Even if interest rates go up, that may help net interest margin. But isn't it going to put a brake on the economy and hurt banks, who have to provide more for bad debt and maybe slow house price growth? If higher rates cause house prices to fall, you're going to have mortgage stress and more bad debts. CBA countered that multi-decade lows in unemployment, wage growth, and high levels of household savings would work in its favour. It expects credit quality to be supported by wages pushing through 3% growth in the coming months. Unemployment will be in the low 3%, and a pandemic stockpile of consumer savings of $250 billion. We have the lowest unemployment rate in 13 years, and are going to touch on the lowest unemployment rate since the early 70s this year, Mr. Cormann said. They are a very strong set of economic conditions showing Australia is performing well, and a good set of conditions for the Commonwealth Bank. Other fund managers agree it will be the pace of the RBA's rate increases and the outlook for jobs that will remain critical inputs in the performance of banks. In the absence of a deterioration in employment, most people should be able to handle small increases in interest rates, said Nick Vidal, investment analyst at T. Rowe Price. But if interest rates increases become prolonged and larger than the market is thinking, that could become an issue for higher impairments in a couple of years. A 1% increase in the cash rate on an average $600,000 home mortgage means $6,000 more in annual interest payments, or about $8,000 before tax. Even if the cash rate increases by, say, 100 points over the next year or year and a half, the increase in the repayment amount will be modest compared to what we've seen on other cycles. The prospect of the cash rate rising to 75 basis points by the end of the year and 1.25% next year would have housing price growth pulling back to about 4 to 7% this calendar year, before residential housing market prices fall between 5 and 10% in calendar year 2023, Mr. Cormann said. That level of retreat shouldn't give our consumers or customers too much cause for concern, he added. Now, we've looked at this in another video where NAB is predicting a 9.3% fall, or even 11% fall in Sydney and Melbourne in 2023. Now, you may think, oh boy, that's, the numbers look big. the numbers will be, particularly in the cities where we've got property over $1 million. Let's just have a look here. Example, Sydney asking prices. Let me reload that. You can see there how high it's getting for property, $1 million, $1.5 million for a 3-bedder. So a 10% fall, 150 grand, that's a huge chunk of money. But it means we're only going back to about 2021 prices. This isn't the correction that people were hoping who can't afford to get into the market now. They're people who are hoping for a dramatic correction as an opportunity to get in. This may be a little bit of a cooling. It may make it a bit easier for some people to jump in if they've got secure employment and opportunities. What all this is highlighting is the big divide that we have here in Australia, the class divide. So, however, a breakout in inflation, potentially caused by continuing pressure on supply chains that would cause the Reserve Bank to lift rates more aggressively, could lead to house prices falling more steeply. Yet for now, the inflation rate does not appear as extreme in Australia as in the US or Britain, he said. For now. It feels like it. I'm going to buy things at Bunnings, home repair stuff, like a little blade for a multi-tool. That's definitely gotten more expensive, guys. Go try and buy some Rio. Try buy a pick, a tool, anything important. It's all getting more expensive. But so long as my hashtag not sponsored $1 coffee from 7-Eleven is still $1, we've got no inflation at all. The expected moderation in house price growth this year should be enough to starve off any additional macro-prudential intervention by the Australian Prudential Regulation Authority to limit housing credit. But Mr. Coleman said the jury was still out on whether credit growth could be pared back. If housing growth and credit growth accelerated much beyond the strong level we've seen in the past 12 months, potentially macro-prudential policy might be looked at more closely, he said. Investors say the practical flow-through of higher rates on bank net interest margins will remain the key focus for the market. Cutthroat mortgage competition is expected to remain even as official rates rise. Competition continues to be a meaningful headwind for margins, and competitive pressure on margins are here to stay. And we would be cautious extrapolating rising cash rates to net interest margin improvements, although it could moderate some of the headwinds we've been seeing, Mr. Vidal said. So this is written by James Ayers and Ashi Dear Krista. So there we go. Some interesting insights into, the RBA is being directed essentially by Commonwealth, guys. Let's have a bit of a talk about this one. So what do you all think, everyone? We're not in a free market here in Australia, not by any measure. The housing market is highly, regulated. And, that's what people want. People don't want a free market here. You can be frustrated. You can think it's unfair. You can see predictions that others are making about housing having to correct. It all seems quite reasonable. But the situation we have now is we've got government and regulatory bodies intervening to ensure stability, to maintain the status quo, and using the housing and property sector as a way to boost our economy and to stimulate the economy. Now, the problem with that is it incentivizes investment in that sector, and it's decanting investment in other parts of our economy. My argument is that it's leading to long-term decline in our economic complexity. And are we ever going to be able to address that? I think this is a cultural issue. Will we see a massive housing market correction, particularly if rates shoot up as inflation goes even higher? Or will we see the definition of inflation change for statistical purposes to make it more accurate? Remember when everyone was getting the free daycare and they used that to count that free daycare funded by government, which is going to be a tax burden for future generations, drove down inflation because everyone was getting it. Awesome. Awesome, guys. What do you all think, everyone? Let me know your takes on this one in the comments. I mean, would you prefer a free and open market here in Australia where the housing market was able to adapt? Or would you want it more, managed to such an extent? Let us know. Anyway, check out this last video about housing predicted to fall 9.3%, everyone. We'll have to see what happens. Take care, have a great day, and I'll see you in the next episode of HeiseSays. Bye for now. Still a good coffee for $1.